On behalf of Ambit Capital, we welcome you all to today's earnings call of Dixon Technologies. From the management side, we have with us Mr. Atul Lal, Managing Director, and Mr. Saurabh Gupta, the CFO of the company. Over to you, sir, for your opening remarks.
Thanks, Dhruv. Thanks very much. Good evening, everyone. Thanks for attending this call. I hope that you and your families are safe and healthy. So I'll just give you a brief on the Q1 performance in Dixon and where does the business stand as of now. And then you're most welcome to raise your queries. So while the headline numbers during Q1, it was quite badly impacted by the pandemic. But the numbers we believe show, and it has demonstrated that there is a fairly strong resilience in facing these extremely challenging times. So we were in a shutdown mode from 22nd of March to May 3rd, when in parts we started reopening our factories. So effectively, some of the factories, they operated for around 45 days, and some of them operated for barely 30 to 35 days in the last quarter. We complied with all the government advisories and paid full wages to our workmen during the lockdown period, despite the nil production in April and large part of May. However, there has been huge focus on controlling the fixed cost, which has helped in delivering some profitability in this quarter. We continue to prioritize safety and well-being of our people. So the lines have been redesigned and they've been re-engineered to maintain adequate social distancing. So the months of April and May were very deeply impacted. Month of April, there were zero revenues, and May was also hugely under pressure. But in June, we came back to almost 70% of a normalized revenue. I'll share with you the status across all verticals. And so in LED televisions, in the month of June, we did almost 200,000 televisions. And in the month of July, we have done almost 250,000 televisions. So the order book in this particular vertical is extremely strong. And we have an order book which is more than our capacity, more than our increased capacity. So you know that we had planned to increase the capacity from 3.6 to 4.4 million. And now, because of certain government notifications and advisories, we are further expanding a capacity which will happen in the next 6 months from 4.4 to 5.5 million, which is almost 33-34% of 14 million demand that India has. This business was slightly under pressure, but now with large anchor customers, it has normalized. The other vertical of ours, lighting, we had some challenges in the first quarter because of redrawing of lines and certain supply chain constraints. But here also now the order book is extremely healthy, and now we are back to almost 85-90% of our business. So normally we do around 15 to 16 million LED bulbs and 1 million battens. So in the month of July, we have delivered almost 13 million LED bulbs and almost 1 million battens. However, I'll share with you the other verticals shortly. So in the vertical of washing machine, we had a very bad quarter. In the month of June, normally we do around 80,000 machines a month. In the month of June, we did around 48,000. But now we are back to normal, and we delivered 80,000 machines in the month of July. The order book in this quarter looks extremely healthy, We have an order book of almost 120,000 machines a month. So we are further expanding our capacity by installing a third line, which will be operational in the next 7 days in the existing factory. Now, this is apart from what we are doing in our Tirupati campus. However, at the same time, we remain cautious because although the order book looks healthy, the production is normalized. But we're not very sure in terms of the localized lockdowns, and that may cause some supply chain constraints. We are also keeping our fingers crossed that the order book that we have, which looks extremely good in Q2, I hope it sustains beyond Q2 and there are no surprises for us. Now, coming to the financial and operational performance of this quarter, so we had a consolidated revenue of 517 crores. We had a consolidated EBITDA for the quarter of 17.1 crores. And the EBITDA margins declined to 3.3%, owing to declining in the production-related under absorption of overheads. The PAT was 1.6 crores. We are well positioned with a robust balance sheet with a cash balance of 64 crores and have enough working capital lines to ensure that even if things worsen, we are fully protected and continue to build our business and capability through the extremely tough period. We have liquidity and enough cushion on the balance sheet if required to raise debt, although we are extremely conservative about it. But we have enough cushion to face the circumstances. So we have been sharing, and I've been insisting that we have a strong conviction that consumer durable and electronic items that will be sold in India are going to be made in India, and that's what the thesis on which Dixon's business model is based. Brand owners, and I can see and sense more traction, will be outsourcing, and even not only the manufacturing but also designing as a part of the strategy. And we feel that in Dixon we have now the scale, the skill set, the capability and marquee customers to execute this well. Also, the government policy framework is getting more and more aligned towards domestic manufacturing in this particular product vertical. So the government, has announced the PLI, Production Linked Incentive schemes, for the mobile phones, wherein they're going to be selecting 5 foreign companies and 5 domestic companies. There's a huge focus on creating 5 domestic champions. So we have filed 2 applications in Dixon. In all, there are 7 applicants, and the 5 have to be selected out of it. We are fairly confident that we are a strong contender. We will be making the requisite investments and ramping up our capacities in the smartphone sector significantly. Capital allocation in our case, we have always been prudent and frugal. We have a hurdle rate of return on capital employed of 30% and return on equity of 25%. And this is what's going to be sustained and maintained in the coming quarters and years. Now I'll share with you the performance and the strategy in each of the verticals going forward. So in LED television segment, we have expanded. So we had a revenue of 347 crores and operating profit of 8.6 crores. We have already executed a capacity expansion which will become operational in the next 2 weeks from 3.6 million to 4.4 million. This is an extremely strong order book from our anchor customers and newly acquired customers like Samsung. You know that we have also acquired various new customers like Nokia, Toshiba, Hisense, and the private labels of Flipkart. The recent notification to curb the imports of LED TV and place them into a restricted category will further enhance domestic manufacturing. And not only the domestic manufacturing, it will also enhance and accelerate the sourcing by brands of domestically designed solutions. Please be rest assured that we are building our R&D infrastructure for offering smart solutions, and hopefully for a very large brand we'll be offering the 4 design solutions in the smart category very shortly. Because our order book is again more than the expanded capacity, we have taken a call to further expand our capacity to 5.5 million by Q4 of this fiscal, which will be almost 40% of the engine requirement. The capacity expansion on the PCBA side is already on the way and will be done within August, wherein we are installing one more SMT line. So this will be the largest Indian capacity, vertically integrated. Then the next phase is going to be to offer more and more solutions which have ODM from Dixon stable. On the lighting segment side, the business was under pressure. So we had revenues of 77 crores in this quarter with an operating profit of 5.8 crores. So you know that practically all the brands in the lighting business are an ODM business. And also now, a very large part of their wallet share is with Dixon now. We have a capacity of almost 20 million bulbs a month, which is 40 to 45% of the Indian requirement. And also our capacity expansion of LED bulbs, of battens and downlighters has already been executed. The recent brand acquisition is the Reliance private label. We feel now the kind of operating leverage that we have with the enhanced volumes and the entire range of product portfolio, we are now globally competitive, and we are among the top 5-6 companies for indoor LED lighting. Now we have taken a call to enter into outdoor lighting. So the design teams are working on these solutions for commercial lights, LED street lights, and floodlights. And I'm very confident that these solutions will be launched and offered to our customers by Q4 of this fiscal. In home appliances segment, the revenues for the quarter were 24 crores with a small operating profit of 40 lakhs. Now we have gone back to 80% utilization levels, delivering 80,000 machines in July, and we have an extremely healthy order book. We have 140 models. Hello?
So we can hear you. Just go ahead.
Yeah. We have 140 models, and this is being further expanded by another 40. And our expansion and the new factory in Tirupati campus for fully automatic top loading is on schedule. We hope to conduct trials. We are confident of conducting trials in this factory by December this fiscal. Coming to mobile phones, revenues for the quarter was 53 crores with an operating profit of 2 crores. We have capacity of 2.3 million feature phones, 2G phones for Samsung, both for domestic market and exports. So in the month of July, we have delivered 2.5 million phones, and the order book again is extremely healthy. So for our anchor customer, now we also started manufacturing smartphones, and this capacity for a smartphone would also be further increased to almost 700K per month. In our other factory for mobile phones, we are mainly doing the 2G phones and the smartphones for Xiaomi and LG. The LG order book looks very healthy, and the balance capacity, we are now servicing the set-top box business, which is emerging as a very major vertical for us. We are having an extremely healthy order book. We have an order book of almost 500,000 set-top boxes a month. We feel in a couple of quarters, this can be built up to almost 800K to 1 million order books, a set-top box a month, which will generate a revenue of almost 1,000 crores in next fiscal for us. So from next quarter, I've advised Saurabh to treat it as a separate category, this particular thing. We have, under the PLI scheme, submitted 2 applications. We hope and we are fairly confident that we will be an approved entity. I'm pleased to share with the stakeholders that we have already concluded an agreement with a very large global brand under this scheme for executing not only the domestic business, but large global business. And with another brand, we are almost at the final stages of conclusion. We strongly feel that if we get the approvals, this is going to be path-breaking for Dixon. We are committed to make these investments and ramp up our capacity. And once we do that, we'll almost have 30% of smartphone capacity for the Indian market. On the security surveillance side, the revenues for the quarter were 14 crores. We had a small order book, and this business is under pressure because I think it's a discretionary item, and this order book continues to be under pressure. However, we are going to be utilizing this capacity by medical electronics devices. So we are going to be starting manufacturing of Quattro RT-PCR analyzer machine for COVID-19. It's going to start within another 2 to 3 weeks, and there are repeat orders for that. So that's going to be again an important vertical for us. On the reverse logistics side, the revenues are only 1.4 crores, and this is a small strategic business for us. And it's going to carry on in a small profitable way for us. So that's where we are. We feel that we are sitting on an inflection point. There are going to be challenges in short term if there is another wave of the virus or the demand falters. But however, we feel that we're sitting on a strong wicket, and hopefully we will do extremely well. So any questions, please, most welcome.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone now. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1 now. We have first question from the line of Niket Shah from Motilal Oswal AMC. Please go ahead.
Yeah, thanks so much, and congratulations, sir, for the PLI scheme application that you've done in advance only. I just had a couple of questions. The first question was on the PLI scheme part of it. Is there a limit which the government has set out? For example, if you do 1,000 crore turnover, is that a limit, or 2,000 crore limit per year which keeps going up? So is there a laddering which we can expect there? That's the first question. And the second question was on the panel side of the business. While you did allude that the demand and the order book continues to remain extremely strong, we do know that TLC has obviously come to India, and they have also set up their plants in Tirupati. So do you think some of the customers with a view of de-risking might also move to TLC over the medium to longer term, not in the near term? So those are the two questions, sir.
So Niket, responding to the first question on the PLI, there is a threshold turnover to be, so there is a budgetary allocation of 41,000 crores as an incentive to be distributed between 5 foreign companies and 5 domestic companies. So what the policy guidelines states is that, let's say in year 1, you have to achieve a threshold turnover of 500 crores or your baseline turnover, and then on the incremental basis, they're going to give, let's say in year 1, 6%. They have not stated, but our understanding is that they're going to be putting some upward ceilings. So let's say your baseline turnover is 500 crores. There would be an upward ceiling of 2,000 crores. So that means the maximum incentive that you can get is on achieving 2,500 crores, an incentive of 6%, that's 120 crores. So something like that. So there would be an upward ceiling. Officially, informally, we know that what those ceilings are, but officially they have not disclosed till now. I think they'll be disclosing once they have the approvals through. Responding to the second question, TCL is coming up with a campus in Tirupati. Any campus coming up would always, it's going to be competition. However, we feel that Dixon is sitting in a much better position, primarily because of two reasons. One, that the focus of TCL is more on its own branding. And the brands which are with us usually do not ship to a factory which is promoting its own brand. And second, we strongly feel that we are much, much more frugal and we have the cost competitiveness. And third, we also feel that now with launching of our own solutions, even on the smart side, we have an edge. But then, competition is going to be there.
Sure, sir. And the third question that I wanted to understand, you did mention that you have already signed an MOU with one large customer and you obviously in discussion with a second large customer. Is it safe to assume that per customer you will use one PLI and for the second you will use a second PLI, because as you rightly said, there is a upward ceiling. So how should one really think about allocation? So is it per PLI you get one application, or for a particular PLI application you can have multiple vendors under that PLI application? How would it work?
So Niket, there is no restriction as per the policy guidelines that how many customers you can have. You can have any number of customers. Government's requirement is that you commit a certain amount of capex, that is 50 crores per year for the domestic companies, with each approval. And then you need to have an additive incremental turnover, preferably from export. However, they have not stated that. So there is no restriction, and we are going to be working with as many customers as possible. But that again depends upon what the ceiling says.
Sure. And sir, one.
Sir, I'm sorry to interrupt. Please come back in the question queue. Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to two per participant. If you still have more questions, kindly join the queue afresh. We have the next question from the line of Ankur from HDFC Life Insurance. Please go ahead.
Yeah, good afternoon, Mr. Lal, and thanks for the opportunity. Just again on the PLI scheme, so while there are large numbers being targeted by the government, in terms of manufacture/assembly of cell phones in India, if you could just talk about how easy will it be, for companies like Dixon and also others to kind of ramp up to such kind of numbers, how do we get that kind of manpower, and also how long will it take for us to set up these factories, because we're talking about, 200 crores over the next 4-5 years. So just some sense there.
So Ankush, I strongly feel that in Dixon now we have acquired adequate bandwidth to execute these projects. If you see last year when we got this opportunity from a large anchor customer for ramping up the capacity up to 2 million 2G phones a month, we were able to do it in 90 days. And now within a very short span of time, we are operating at 110-115% of our capacity. So to reiterate, we feel that we have that internal capability and a skill set. We have our plans ready. A lot of groundwork by the team has been done. And we feel that if the approvals are given, we will be able to utilize the PLI incentive scheme benefits within this fiscal itself. So that effectively means that we should be able to set up the plant and get it running within the next 4 months and achieve also the threshold turnover and cross it. When this is small opening, a small period of just 7 months, we feel confident about it. But any deliverable is always a challenge, and all the more a challenge on account of pandemic. But we are fairly confident that we'll be able to deliver on this.
Okay. And just a second question on the margins you expect to make here. Obviously one is of course the incentive which you get, 6% for the first 2 years and so on and so forth. And then on the value added by you or as in any of the EMS players. So how should we look at that? I mean, you currently make margins in that 2 to 4% range. So is that a minimum, and then plus how much you decide to share with the brand? Is that how we should look at it in terms of the kind of margins you make out of these PLI scheme-based cell phones?
So Ankush, it'll be difficult for me to share the granular level details, please, because they're confidential. And what I can just share is that margins are going to be better than what we do presently in our mobile business.
Okay. And just one last to Saurabh. I was just looking at the interest expenses in the P&L. While we had debt of close to about 86 odd crores end of March, our quarterly interest cost, when I look at Q1 is at around 6 crores. So is there something else sitting here? Even last year was around 35 odd crores. So I'm just wondering why the high interest expense.
So we also do, so this 86 crores of debt does not include the discounting of receivables that is done. So that is not included in the debt number of 31st March, which you had just mentioned. So that is over and above. So as a result, the interest cost is slightly higher. So that interest on discounting would be a difference, would also be over and above this number.
Okay, so would you have the split between the interest and the discounting charges for the full year, maybe for FY20 at this point, or for Q1, whichever, either way. I'm just trying to understand how much that is.
Yeah, so in this quarter, our discounting number was around, interest on discounting was around 2 odd crores. So out of this 5.5 crores kind of interest number, 2 crores was the interest on discounting.
Okay, great. Thank you so much.
Thank you, sir. We have next question from the line of Aditya Bhartia from Investec India. Please go ahead.
Hi, good evening, sir. So my first question is on margins in lighting and TV businesses, which have remained fairly steady despite the drop in revenues. So just want to understand how has that been made possible? What kind of cost reductions have you taken? Is it that fixed cost in the business itself has gone down? And should we assume that sustainable margins can be slightly better than what we have seen in the past?
So I'll say you're right. You'll see a slight improvement in the margin in the coming quarters.
And what exactly is that on account of, sir? What kind of cost reductions have you done? If you could just kind of elaborate on that.
First, taking you through the LED televisions, it is primarily because of the deepening of manufacturing. For the new customers and the new large customers, one, we are doing PCBA now, for which the capacity is being doubled. The second is there is a shift more and more to the larger screen sizes. So the numbers for large screen sizes like 50, 55 inches are significantly increasing, wherein the margins are better. So this is the primary reason for margin expansion. On the lighting side, it is a combination of value engineering, the design route. Second, operating leverage kicking in because of a large share of business. Third, huge focus on productivity enhancement, on which the team is putting everything under the lens. In any case, the fixed cost in the lighting business is always be hugely under control. So you have seen the traction in the lighting business that the margins have been expanding. primarily because of these 3-4 reasons. You'll see a small expansion in the lighting margin in the coming quarters.
Sure, sir. And so in the past, you have indicated that we'll be going for increased automation on the lighting business. So if you could just share some details about what could be the timelines of these automation. Is current social distancing restrictions having an impact on lighting performance? And what kind of margin bump up could we see on account of that?
So 7 automated lines have already arrived, and they are under installation at our Noida plant. There are some challenges because the technical experts, because of the travel restrictions, have not been able to travel to our factory. So our engineers are installing these lines themselves, and they're basically PLC-based lines. So through virtual interaction, they're installing it. There would be some challenges, but I feel that by September these lines would be installed. And this, on the LED bulb side, it improves the production cost by or the margins by almost 1.5 to 2%.
Understood, sir. Thanks a lot. Thanks.
Thank you. We have next question from the line of Renu Baid from IIFL. Please go ahead.
Yeah, hi. Good evening, sir. So my first question would be to understand a bit more on the categories like washing machines, where we have seen volumes struggling now for almost quite recent quarters. So is it again a reflection of overall weakness in the consumption side of the business? And could again, I think this trend has been continuing since last year post Diwali, so almost 3 to 4 quarters now. So does that worry you that given the pandemic impact, the festive season might not be as exciting, and which can also have an implication on the growth prospects for some of the revenues for your brands in this category as well?
So, Renu, you're absolutely right. The washing machine numbers were under pressure post last Diwali, and pandemic did the final bad job of hurting the business. However, in the month of July, we have done 80,000 machines, and as I'm sharing with you, we have an order book now of almost 115 to 120,000 machines a month. So there is a very definitive uptick in this particular segment, and all the more I'm seeing that the competition is much more under pressure. So a lot of business from large anchor customers is shifting to Dixon.
Okay.
So on a very short notice, I had to put up my third line to expand this capacity, which is at 100K to almost 120K. So I don't see a challenge, and I feel that it's going to be on a growth path. Until unless, because of the pandemic and virus, the demand absolutely collapses. That's something different.
Sure. And 2 more questions. The second would be on the PLI scheme. Just a clarification. When we talk of incremental sales, the government hasn't specified whether these are incremental sales coming to the overall market or the brand. So for an applicant, say, in the domestic manufacturing side, where today almost more than 2/3 of the 70 to 80% of the volumes are manufactured or assembled in India already. So does this imply that the incremental revenue numbers also include the potential reallocation of production units from the existing manufacturing units to the newly allocated PLI partners or schemes here?
So what your understanding is right. However, in Dixon's case, the agreements that we're concluding, most of it is going to be additive, because large part of it is going to be global.
Okay. So it would not involve much of reallocation in your case with your OEM partners with whom you're signed through.
I'm saying that there will be reallocation, but a large part of it would be additive because it's from the global markets.
Sure. So second, for Saurabh, I have a couple of questions. What is the gross debt that we have on the books today, gross debt and the net debt at the end of the quarter and overall on average during the quarter?
So our net debt is actually, the latest net debt is around 55 odd crores. So cash, we mentioned in the call that the cash balance is around 64 crores. So the gross debt is somewhere around 125 odd crores.
Sure. And broadly, the working capital during the year, as in if you knock off the impact of discounting of receivables, etc., what would have been the average working capital or short-term debt that you would have used during the quarter?
So similar, so we would have used some. So one thing which I forgot to mention, so within that 5.5 crores of interest, there is also an interest obligation on the lease, the India's accounting, AS19. So that number is also 1.8 crores. So if you exclude 1.8 crores and the 2 crores of discounting, we are just talking about a number of only 3 odd crores, 2.5 odd crores. So that is basically the interest on the working capital facilities. So our average utilization would have been somewhere between 60 to 70 odd crores.
Sure. And broadly.
I'm sorry to interrupt, ma'am. Please come back in the question queue. Thank you. Kindly restrict questions to 2 per participant, ladies and gentlemen. We have next question from the line of Tejas Sheth from Nippon India AMC. Please go ahead.
Hi, Atalji. Hi, Saurabh. Sir, what would be the criteria for the selection under the PLI scheme? I mean, what would be the government's top criteria? And I just wanted to understand how can we land with both the application getting passed out?
So there is no absolute clarity that what all would be the criteria because they've asked for a lot of information on the export potential, on the employment generation, on value addition. However, our understanding from informal sources is that it's primarily going to be the revenues of mobile manufacturing generated in the year 1920.
Okay. And so the PLI scheme will kind of have a cap when you do with the benefits you'll be getting from the government. So would the contracts which you're signing with the brand companies be beyond, would also have volume beyond PLI incentives which they can claim just to get benefited from economies of scale?
Yeah, it's going to be like that.
Okay, so even that the volume could be much larger than what you can claim under PLI scheme.
Yes, the numbers would be higher than the prospective ceiling of those revenues in each of the years, which is of course the government has not notified, but whatever was based on our informal sources or earlier mentioned, the numbers would be significantly higher than that.
So I shared in my opening remarks that the capacities will be creating in mobile would be almost 30% to 35% of the Indian requirement. Now, this is much more than the ceiling.
Okay, got it. So last, just on what is the chances of PLI coming in the other electronics and white goods, be it TV, washing machine, ref and ACs? I mean, how you see that panning out?
That's a very difficult question to answer, but you know that PLI has already been announced for the medical devices.
Yeah.
And what our understanding is that they're working on various other products. They're looking at set-top boxes. They're looking at lighting.
Okay.
These are some of the product categories in which Dixon is.
Okay. Thank you very much, sir.
Thank you. We have next question from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. My question is with respect to capital expenditures. Given the PLI scheme and other capexes which you were putting in or wanted to put in refrigerators, Can you throw some light? How much would be our capex in the next 2 to 3 years, including this PLI scheme?
So if you see a normal run rate of capex is around 80 to 90 crores. The PLI, depending upon the number of applications that get approved, each application requires a capex of 50 crores a year. So that's what the range is going to be. I feel that if we get one approval, is going to be in the range of 130, 140 crores. If we get two, then it's going to be higher.
So, for example, even if you get one, does that entail, including the ref line? I think that is also what we discussed. You have a plan for that, and plus your normal capex of what you're doing of increasing TV capacity as well and washing machine. You think that given that capex is in the next 2-3 years could be in the range of 300-350 crores, it's better to raise funds, or you think the sufficient cash flows will be there to meet the requirement if it's in the range of 300-350 crore plus?
So as per our business plan, we can see that we're generating adequate cash. We can raise debt also. So no final decision has yet been taken on any fundraise till now.
There is a plan.
So one of the moving part is, of course, whether we get one PLI or two PLI applications. So that would determine, and that will help us forming our capex plans. And we think there is enough cushion in the balance sheet today. So the debt to equity ratios, debt to EBITDA ratios are still very low. So we can always raise some more debt. The balance can be funded out of the internal accruals as well. So we are discussing it, deliberating it internally. But yeah, we haven't firmed up on the capex. So once we need to have a full clarity on the capex plans, and then we will finalize any fundraising plans, if any.
Got it. Thank you very much.
Thank you. We have next question from the line of Nitin Bhasin from Ambit Capital. Please go ahead.
Thank you. Mr. Lal, you mentioned about the PLI. One of the first questions around the PLI and the mobile manufacturing smartphone is that when we look at people like Foxconn, Flex across the world, and we see their margins are very low at about 1.5 to 2.5% margins. And whereas in India already the smartphones are making really good numbers, and you also mentioned that the numbers could be even higher. Do you think, when these global brands now work at such large scale with you, would you be able to build on these margins, or the bargaining power will possibly force us to be around here only? Just a little better sense on the margin structure. How should one look at it, because the global experience suggests otherwise?
So what we have internally designed the business model, I feel that under the PLI, our margin profile is going to be better. Not hugely better, but fairly better.
Sure.
We strongly feel that we are much more frugal and cost conscious than the large global EMS. And that's the way we're going to run it.
Okay. Sir, because why I was asking that is because globally these guys go to 6.5% gross margin and they land up making 1.5% this thing. So, but you're saying that the cost structure in India is much favorable, and possibly because of which you can make higher. Great, sir. So, how should one think about working capital as you work for possibly a global brand to export? Because though the capex requirement is not materially high, how should one think about working capital in the smartphone business, sir?
So in Dixon's case, you know that we are extremely conscious on the operating cycle and the cash deployment. So it's going to be working capital neutral. However, in the initial ramp-up phase, there might be some working capital deployed. Otherwise, it's going to be on a neutral side. There will be no funds deployed by Dixon on the working capital finally when the business stabilizes, which can take a quarter or a couple of quarters.
So Nitin, that would be the understanding with the customers that we are talking about, that there will be no working capital deployed once the business stabilizes. So initially, yes, for a couple of days or maybe for a month, there can be some working capital deployment, but otherwise, that broad understanding will be captured and that will be completely met. There will be no working capital in the business, in the mobile PLI business.
Okay. So basically, working capital in that business could be lesser and possibly margins could be higher, which means that the stated guidance of ROC will be materially equal to what it is today and materially much better than what a Foxconn or a Flex globally reports. That's the right way to look at it and summarize it.
So we strongly feel that if we are able to get these PLI approvals, the kind of agreements that we are closing on,
sure,
there will be a significant flip to the return ratios.
Great, sir.
ROCs would be significantly higher in this mobile PLI business. The paybacks would be significantly higher. And as a result, the company level, since mobile PLI will start contributing significant portion of our revenues, and mobile as a category would start contributing a significant portion of our revenues. So the overall ROCs at the company level, we expect to see a significant growth there.
And so that will be FY22, right? The first good year of revenue.
Yeah, FY20. So this year it will be mostly 3 months of operations, and there also you may end up deploying some bit of working capital. Yeah, but yeah, for next year onwards, you would see a significant growth in ROCs coming mainly from this mobile category.
The last one, very brief, small one. When you think of these 2 PLI licenses that you applied, and let's say you get both of them also, or for that matter, let's say you get one. In either of the scenarios, how much of your smartphones one should think of could be exports?
So the contracts being negotiated.
Sure.
It depends whether we get 1 or 2. But we feel that if we get 1, then almost 50 to 60% would be exported.
Okay.
Then if you get 2, then overall percentage would be slightly lower.
Sure. And so because in the domestic market you have to look at the under $200 phone, but in the export market, would the brand still choose you for a under $200 phone, or it could be anything?
It's going to be a mix. It's going to be sub $200 phone. It's going to go up to very high-end phones as well.
Okay. So thanks a lot for this. I appreciate it. Thank you.
Thank you.
Thank you, sir. We have next question from the line of Vihang Subramanian from Samsung Asset Management. Please go ahead.
Yeah, thanks for taking my question. So, as you mentioned, you would be creating almost 30% of India's smartphone capacity, which is a pretty significant number, right? Like almost 6 to 8 billion USD. So just wanted to know, how should one think about when will all this crystallize in over what time horizon? Because this even entails like a significant investment of almost, I think, 3,000-4,000 crores, right, from your end. So just wanted your thoughts on this.
So the investment numbers that you're mentioning, those are not the investments required. As per our internal plans, the investments for 2 approvals is going to be 400 crores spread over 4 years. And these kind of significant revenues would be generated by year 4 or so.
Okay. But how much in your opinion, sir, would be like 10% of India's smartphone capacity if you said that 30%? So 30% would entail almost a turnover of 60,000-70,000 crores, right? So for that, you would obviously require more capex than 200 crores, right?
So the Indian present market is around 150,000 crores. And when we're talking about this 150,000 crores, is the customer sale price.
Right.
Side, and particularly when you're talking about sub $200 phone, that number is significantly smaller.
Got it. Okay, sir. That's it from my side.
When I'm talking about that kind of capacity, it's volume-wise, it's not value-wise.
Thank you, sir. We have next question from the line of Naval Seth from MK Global. Please go ahead.
Yeah, thank you, sir. Two questions. First is on working capital. Why there is kind of deterioration on working capital? So if you can, share your insights, and has that improved in month of July, or we are still at the same levels of quarter-ended number?
So, Naval, the working capital impact primarily happened because of our television vertical, not in any other vertical. That is because both Samsung and Xiaomi, the consignments had got delayed, the custom clearances got delayed, and also the deliveries got delayed. But please be rest assured that it's already in the improving syndrome, and by the end of September, by the end of Q2, it will be back to where it was.
So Naval, it is just an aberration this quarter, and this is mainly because of the delay in shipments, as Mr. Lal mentioned, which led to delay in production and delay in booking the sales. So this is just an aberration. A lot of that has already corrected in the month of July, and you will see it going back to the similar range of levels of working capital which we had reported in the last 2 years. So we'll go back to those -3 to +3 kind of working capital range.
Okay. Second question is on STB business. Although you have stated quite bullish outlook over there, can you share some insights on customer, whether it is for domestic or export markets? How things are in terms of the order book would be, coming in.
So, Naval, this is primarily for domestic market. It is on prescriptive basis. It is primarily EMS assignment. This is mainly from Jio. This is from Dish TV. This is from City Cable. And this is from some cable operators on the eastern side of India.
Sir, given the financial challenges what a City Cable or a Dish TV is facing, can we see some risk arising, incrementally the way we have seen in case of Reliance Digital set-top box business sometime back? So, are we protected there this time around?
So please be rest assured there's no fund deployment by Dixon in this business.
We are well protected, Naval, in that sense.
Thank you, and all the best, sir.
Thank you, sir. We have next question from the line of Shriyash Bukhanwala from Canara Robeco. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, on the STB thing again, so you said probably we are looking at almost 1,000 crores of revenue next year. What kind of profitability can be expected from this segment?
So it's a similar EMS kind of margins between 2.7 to 3.2%.
Sure. And sir, secondly, on the lighting side, so you mentioned that almost 7 automated lines we are installing. So post this installation, how much of our volumes probably would get catered from that automation side?
So this is going to be almost 1/3 of the volume.
1/3 of the total volume. Sure, sir. Thank you.
Thank you, sir. We have next question from the line of Deepak Mehta from MetLife Insurance. Please go ahead.
Hello, good evening, sir. Thank you for taking my question. So I was comparing the financial statement from last quarter. I was seeing that our cost of goods means raw material has gone down. Ideally, it was supposed to goes up, right, sir? Can you throw some light?
Well, you should look at both the cost of material consumed and the change in inventory of finished goods and the work in progress, and then come at a COGS percentage kind of a ratio. So that is not materially changed from the last quarter. So it is somewhere around 88%. That's what you should look at.
So it is on the same line.
It is on the same line, sir.
And what about the labor costs? Are you seeing any this pay cuts or salary cuts or labor this compensation cuts? What is the trend in Noida, sir?
No, so the wage structure remains the same, which was pre-COVID.
Okay, it remains same.
Yeah, yes, it remains the same.
And my last question is that from Reliance Jio, what we know that you get the contract manufacturing for mobile phone and set-top box. Apart from this, is there any possibility if they comes into 5G, we may get the contract manufacturing for some of the 5G equipments or anything IoT related things? Is there any talks or possibility in future?
So presently for Jio, what we're doing is set-top boxes. We have not yet done there's no contract as of now on the smartphone side. So what we're doing is various kinds of set-top boxes. We're doing hybrid set-top box. We're doing dual tuner cable set-top box. We are now co-designing for them another kind of set-top box. At present, it's this. However, Jio is going to be a strategic customer for us, and we hope that we're going to keep getting more and more opportunities.
Thank you, sir. We have next question from the line of Bhumika Nair from IDFC. Please go ahead.
Yeah, good evening, sir. So if you could just talk about the newer opportunities in terms of what we are looking at in terms of the washing machines in fully automatic and also exports for lighting. That was question number one.
So, Bhumika, our FATL, fully automatic top loading factory, is coming up. In spite of pandemic, the factory construction, the equipment preparation, the toolings, the organization build-up is on a schedule. We feel that the factory and the equipment will be ready within Q3, and we are taking an extremely aggressive target of doing our trials by December in this year. All this is ODM business. We are there right from 6 kgs to 10 kgs platforms. We are launching almost 40 to 45 models. An anchor customer has already been tied up with. We are in discussions with some large tier 1 customers. Tier 2, tier 3, we do not see any challenge at all in acquiring this. So that's on that. On the lighting side, our first consignments of LED bulb exports for our anchor customer have already been shipped to US and to Indonesia. We are in discussion with some very large retail chains. But what I can see is that these things take time. They first want to see a performance before scaling it up with you. But we are extremely bullish that we'll have significant breakthroughs in the coming quarters on lighting exports as well.
Okay, so just an extension on lighting. So, 1Q was fairly weak because of the lockdown, and you spoke about, July kind of scaling up quite well to 80-90% levels. As we move through the rest of the year, do you think that, the lighting is a very significant contributor to our base business? Do we think that we'll be able to make up in the balance 7-8 months, or do you think that now that will be a challenge given the loss of 1Q?
So, lighting in the month of July, we delivered almost 12.8 million bulbs and 1 million battens. 12.8 is almost 80-85% of our normal. Hopefully by September we should be back to normal. The order book is healthy, but I feel that to cover up for the loss of first 4 months will be difficult. That's what my sense is.
Sure, sir. I'll come back in the question queue. Thank you very much and all the best.
Thank you.
Thank you. We have next question from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thank you for the opportunity. Hello, gentlemen. Sir, first question is, so among the top 3 categories, so TV, lighting and washing machine, you clarified the lighting. So TV and washing machine at this kind of monthly volumes, are we already doing better than the same month last year?
Yeah. We are higher than the same month last year.
So July we would be higher than similar month
July.
last year.
Okay. Perfect. Sir, second question is on the PLI scheme, so mobile realization. So the kind of applications which Indian players are doing, so below $200 phones. So what could be a right number for per unit realization for us? 5 to 6,000 would be a good number, or your thoughts on that?
So, it's going to be somewhere around 5 to 6,000 rupees, average.
Okay. And just last question on the working capital / interest cost front. So this quarter's interest expense would be an aberration, or you think this is a sustainable number, or with increased activity, this can again go back to say 8-9 crore rupees per quarter kind of run rate, and except the new capex related project finance debt.
Yeah, so if you exclude the capex from the term loan side, which we may take for funding our capex for the future months, then this would be the going run rate.
The current run rate. Hello.
Yeah. This would be the run rate which you had shown in quarter one would be the going run rate for the future quarters as well.
Okay, perfect, sir. Thanks a lot and all the very best.
Thank you.
Thank you very much, sir. Ladies and gentlemen, due to time constraint, that was the last question. I'd now like to hand the conference over to the management for closing comments. Over to you, sir.
So thanks very much for attending the call. Really appreciate it. We have shared the insights of our existing business status and the future opportunities lying ahead of us. We feel extremely energized, and we strongly feel that the industry, and so is the case with Dixon, we are sitting on an inflection point. We have to really deliver on this. Opportunities are large. Thank you so much, everyone.